Ladies and gentlemen, good afternoon. I am Alex Benos, CFO of Cenergy Holdings, and I'd like to welcome you on this sunny afternoon to today's live webcast on our company's 2025 financial results. Next to me on today's call to comment and discuss their segment's performance and outlook for 2026 are Mr. Ilias Bekiros, General Manager of Corinth Pipeworks, and Mr. Kostas Savvakis, General Manager of Hellenic Cables. Let us now follow together the highlights of our results. 2025 has been a year of very strong performance. It was characterized by growth both in revenue and operational profitability, disciplined execution in both segments, and margin expansion. The adjusted EBITDA for the year was equal to 348 million, an increase of 28% from last year, while the revenue surpassed the 2 billion threshold, reaching 2.1 billion, 15% higher than last year, with both segments showing very strong momentum in sales. Our backlog is a robust 3.4 billion, slightly higher than the one we announced on Q3 2025, and margins have reached almost 17%, record levels for both segments, especially steel pipes, as we will discuss in a while. The free cash flow generation was also strong at 23 million, which allowed us to finance more than 260 million of CapEx. Leverage is still at very low levels, almost 1x EBITDA, and even lower if we allow for the cash we received 15 months ago from the share capital increase in October 2024, and with both segments showing important operational achievements. A capacity expansion that we've discussed quite often in the past for the cables business, both for the offshore facility, which is now completed, and for the onshore facilities, the two plants in Greece, which is almost done and which is expected to wrap up in the first half of this year. As for steel pipes, it is showing its commitment to sustainability, since it has completed the largest industrial rooftop photovoltaic system in Greece, giving almost 80% of its needs in electricity from renewable energy sources, and at the same time, it has also completed the important cement weight coating for steel pipes, which allows the company to get into deep offshore projects. All of the above has put us in a good path towards setting an EBITDA guidance for 2026 in the range of 370 million-400 million, meaning that we are very likely to reach the medium-term ambition set in 2024. I remind you that was in the range of 380 million-420 million. We are expecting to reach those levels 1 year earlier. Let's see together now the group key financial figures. First, looking at sales. As I said, revenues surpassed 2.06 billion, a 15% increase from last year. If we break that into the well-known projects and products business units, we start from the focus on cables projects, which showed a 38% increase from last year, reaching almost 790 million euros for the year, with steel pipes projects following suit with a lower increase in monetary terms, but an important increase in volume terms. As laid out in our press release, there was an increase of 17% in volume terms, which means that all these production enhancements that were made in the previous years and that lead to better production planning and execution led to higher volumes, which will sooner or later, of course, bring an increase in euro sales, dollar sales, monetary sales as well. We should, of course, take into account that in this environment that until Q3, the prices in the steel pipe market were lower, and that a weak US dollar made receipts in euros seem lower just by the translation effect. The important thing for steel pipes here is not the 4% increase in monetary value of sales, but the fact that an efficient production and the modern CWC line give a much stronger revenue growth expectation. Then we do have, of course, cable products, which showed a significant increase of 14% in their sales. You should also note that the split that we see between projects and products in cables is clearly moving towards projects. It started in 2024, rather shyly, I would say, with a 52% share for projects at that time, 572 versus 526. And that is now clearer. In 2025, we have 789 million from projects and only 600 million from products. So the share of projects this year is around 57%. I will not comment a lot on the hollow sections sales in the steel pipes, which remain constant around 25 to 30 million every year. From a geographical standpoint, we should really keep two messages if we look at this timeline of evolution for sales. The first one is that the prevailing share of Europe for the group, it has grown from 42 to 48 to 66, so it's going towards 50 plus or 60 plus % of the revenues, and the shrinking share of Greece. The penetration in the Americas is still moving around, having its ups, having its downs. This, of course, is expected to change over the next years once the Maryland cables facility is completed, and that will give an impact on group sales starting in 2028. The value over volume strategy is still a central point in our company. That is clearly shown by the fact that a 15% in turnover translates in almost double increase in operational profitability. So we do care much more about the value we offer our clients and the profit we offer to our stakeholders rather than the volumes per se. Margins are again very strong. They gain more than 170 basis points from 2024, reaching almost 17%. A part of it is due, of course, to the exceptional performance of Corinth Pipeworks, but the trend in cables is the strong underlying factor, since projects will continue to occupy more of the cables revenue, and their margins, as we all know, are the stronger ones, and they will keep rising. More of that, of course, will be given to you later by the general manager of the segment. Looking at the backlog is still a robust number, 3.4 billion at the levels of 2024. This is really, you should look at the backlog as a water tank result. It means that it depends on the inflow of new awards, but also the outflow due to execution. And if we look at first at the cable segment, the awards that the cable segment got in 2025 were over 800 million. As extra Corinth capacity, I mean the extra capacity in the submarine facility, came into play, during the same year we had more than 900 million, 950 million executed for projects of previous years, including parts in the frame agreements, which means that the cables backlog actually shrunk a bit, since we had more projects executed than gained. This does not, of course, decrease or diminish in any sense the very important amount of new awards gained throughout a year. For steel pipes, the story is a little bit different. The new orders were higher than the projects executed and invoiced during 2025, and that led to a backlog of almost 500 million, 490 million. The important part, however, is found in the right hand of the slide in front of you, which is diversification. If we look at the cables backlog, one could say that it's not geographical diversification, which is a strong point, since most of the backlog is concentrated in Europe. Of course, we plan, as I said, to slowly change that with the cables plant in the US, which will be operational in the second semester of 27. The important point of cables is the bottom part, the applications split, which is rather balanced. 44% in interconnections due to grid enhancements necessary in Europe and elsewhere, another 30% in offshore wind, and another 30% in other, which include frame agreements. For CPW, the story is again a little bit different. CPW is more diversified in geographies, with a large chunk of the backlog, of the current backlog in Americas, and the rest equally split, one would say, between Europe and the rest of the world. An important part here is that CPW is earning awards in the US despite the uncertainty in geopolitics and the tariffs imposed by the US administration. This means that the clients are willing to bear that extra cost in their budget in order to receive top-tier pipes for their project, especially deep offshore, where CPW has a clear advantage. And in application using our pipes, we see that a large part, a significant part, is in fossil fuel networks, oil and gas, but CCS keeps on a noteworthy 20% share in future revenues. Profitability. Profitability rose at 250 million profit before taxes from 180 million last year. The important factors that we should follow here is 61 million more gross profit from the cable segment, 14 million from steel pipes, higher, of course, SG&As because requirements increase with revenue rising, lower finance charges of around 18 million, 17.7, without excluding the FX cost. What is this cost of 6.6 million that you see on the chart? The 6.6 million is the delta from FX losses and gains that we had in 2024. I remind you, these are due to the fact that we have a US dollar exposure. The US dollar exposure is due to the needs that we do have for our US plant. And as the US dollar weakened throughout the year, that produced FX accounting losses. And there is also a higher impairment, than 2024. The rest are just adjustments from last year. So we arrive at a PBT of 249 million, which then translates into 194 million in bottom line profit after tax. I just note here that if you have followed through the financial results of our competitors, you will see that we are now close in absolute terms to the results, to the bottom line of 2 out of 3 of our competitors, despite the fact, of course, that they do have, I would say, at least 70 to 100% higher revenue than we do. And this is a very promising scenario for us, and we're trying to really keep it going because, as you all know, Cenergy Holdings is deeply focused on delivering returns. That was the message of the management throughout all these 3 last years. The share price has shown tremendous performance. It has more than doubled from its level of the share capital increase in October 24. The return on capital employed is close to 30%. It is the highest versus all competitors in the same industrial sector, and it's due, of course, to the profitability margins, which are very strong. And given these 2 positive metrics, the company would like to share some of this fruit of success with its shareholders, and especially those that followed the company in this trip to growth, which is still ongoing. That is why the board of directors will propose to the ordinary general meeting in May the distribution of 26 cents of dividends per share, an increase which may seem very large in absolute terms, more than 80%, but still gives a yield of 1.25% compared to the share price of today, in line with industry peers. The company managed to generate positive free cash flow throughout the year. The EBITDA of 340 million was enough, together with the changes in working capital, was enough to pay income tax, to pay finance charges, and to cover all CapEx payments for the year, excluding those that were due to be financed by the share capital increase. So if we look at the adjusted free cash flow, as we call it here, this is a positive 23 million euros. It might not seem as a high conversion rate of EBITDA to free cash flow, but it is still very positive given the important amount of CapEx undertaken throughout the year. If we, of course, deduce the CapEx payments for the US plant, which are financed by the share capital increase cash, this turns into a negative free cash flow, and then you have almost the same amount of money that we had in the beginning of the year. We are left with the same amount of money at the end of the year. In this calculation, of course, I should be very clear to say that the CapEx, which is not due, but whose objective is to develop the US plant, has a specific availability through what I would call cash in the drawer. So although in accounting terms, it is included in the CapEx payments of the group and of the cable segment, from an analysis point of view, it should be kept aside. In a sense, it is like developing, like establishing a new company from the bottom up in the United States of America. For that company, we have received money through the share capital increase. This money will be spent, most of it, in this year as well, as construction works are in progress as planned. And if need be, next year we will see alternative ways to finance maybe working capital or other small charges that will come up after the factory is close to operation. The balance sheet remains very disciplined. As I told you, there were 263, almost 264 million addition to assets, 43 million for the US plants, 94 million for the offshore cables facility in Corinth, 98 million for the two facilities in Thiva and Eleonas. Thiva is almost finished. Eleonas is also in very good shape. It will be fully, really operational and ready to show its image as a center of excellence for low voltage and telecommunication cables, September this year, and another 29 million from the steel pipe segment. The net debt is low. We had only an increase of 50 million, which leads to a leverage ratio of 0.6 times if the cash from the share capital increase is included. If it isn't, this 0.6 increases to 1.04, which is very respectable indeed. Finally, the negative working capital that we see at the end of the year is really an issue of our business models, with both segments dealing primarily with projects, which means that the project execution timelines and the revenue recognition timeline affect the working capital, which is recorded on a specific date. Milestone payments during the last month of the year may push working capital lower. Now they push it to a negative level. For your analysis, however, you should keep in mind that a normalized level of working capital for the group would be between 6 and 9% of sales, as we have also mentioned in the past. Turning to segments, I start with cables. Cables, the story, I think, is a very clear and positive one. You have a 20% increase in sales, a 34% increase in EBITDA, and a 44% increase in earnings. That's the usual waterfall of a successful company in a growing sector. Our comparative advantage, as we said often in the past, is the same and remains the same: operational efficiency, flexibility, and commitment to quality. Mr. Savvakis will elaborate on all these points later. As for CPW, the story here is a 4% increase in revenue, in turnover. That translates to a 15% increase in adjusted EBITDA and to a more than double, 36% increase in EBT. This is an amazing performance of a top-tier industrial producer in a rather mature sector where some larger competitors are already showing serious weaknesses. And the very low net debt is really linked to the great working capital management for a sector where the raw material steel cannot really enjoy the privilege of a market-quoted commodity as is aluminum and copper. Finally, after all that, we will now turn into the forward-looking perspectives of the company. I will first pass on the floor to Mr. Kostas Savvakis, General Manager of Hellenic Cables, for his thoughts on 2026.
Okay. Thank you. Thank you, Alexandre. I would also like to welcome you today in this webcast with the Cenergy Holdings results. May I say that in 2025, we are glad to say that the cable segment achieved the most successful year to date. This was actually based on strong foundations that we decided the previous years, and we also took advantage favorable market conditions. All this resulted in a record-breaking turnover and profitability, as Mr. Benos, as Alexandros just said. We need also to highlight that major expansion programs across both onshore and offshore manufacturing plants in Greece are nearly completed, and there is also significant progress that has been made in the construction of our Maryland facility in the United States. A couple of financials, we just saw that revenue for 2025 reached 1.46 billion, marking a 20% year-over-year increase. It's this important growth. It was actually driven by the continued execution of submarine and underground projects, along with resilient demand that we faced for cable products. A couple of examples of notable deliveries last year, we had the Ostwind 3 project for 50 Hz in Germany. We also produced the export and the inter-array cables for the Baltic 2 and 3 offshore wind farms in Poland for Equinor. And also in the land cable side, we manufacture the 220 kilovolt underground cables for the Gennaker project. Adjusted EBITDA reached 241 million euros, with the margins improving to 16.5%, reflecting disciplined project execution, high utilization rates across our production facilities, and of course, favorable evolution of the sales mix. Alexandros shared with you, we are happy to say that we had 800 million euros of new awards last year in both land cables and subsea and offshore business, which resulted in a backlog of almost 3 billion euros. Actually, it's 2.9. And this order book includes turnkey projects in the high voltage market, as well as long-term framework agreements, primarily in the medium voltage market. Some recent awards that were also press released is the BC Wind offshore wind farm in Poland by Ocean Winds, the RTE project for Dunkirk offshore wind farm in France, and also here in Greece by our client IPTO. It's the interconnection between Corfu Island and Igoumenitsa. And of course, on top of that, we have several framework agreements with European distribution networks that mainly involve low and medium voltage cables. This diversified backlog in applications, products, and geographies continues to bolster confidence in our future performance. On top of that, this order book provides very strong visibility for the coming years and reinforces our position, the position of Hellenic Cables as a key enabler in the energy transition. For 2026, may I say that we expect full utilization of all our manufacturing plants. If we want to go to cross the Atlantic now, turning to United States, the development of our cable manufacturing facility in Maryland is progressing on schedule. We are on track, and we anticipate to enter the dynamic market of North America in the second half of 2027. It's important to say that USA market conditions remain strong. The grid needs to be replaced due to its age. It's quite old, the US grid. And it's also need to be expanded and modernized in order to accommodate the increased demand for the data centers. And the Maryland facility, it's important to highlight this. Once operational, will be strategically located and positioned in the data centers development map. If you have a look on the East Coast, you will realize that we are exactly on the epicenter of this development. Our segment continues to experience strong demand across onshore and offshore projects, as well as solid demand for the cable products. The high voltage market, it is mainly driven by interconnections and offshore wind. This market remains robust, and we just stated that electricity grids are expected to see further growth, fueled mainly by investments in the replacement, extension, or modernization. Our investments and capabilities are designed to capitalize on these trends in order to enter the next phase of growth with enhanced manufacturing capacities and strong commercial momentum. In summary, for the cable segment, please allow me to say that the ongoing transformation of the energy landscape is generating demand for our products and services. We face favorable market conditions driven by rising electricity needs, increased integration of renewable energy sources, and the replacement of aging networks. All this have generated strong traction for Hellenic Cables. This is a positive trend that we expect to remain in the coming years. Overall, the capacity expansions at our manufacturing facilities, our entry in the North American market through the Maryland plant, and our substantial backlog of orders reinforce optimism about our future performance. That was about the cable segment, Alexander.
Thank you, Costa, very much. Thank you. So now I will give the pass on the floor to Ilias Bekiros, the General Manager of Steel Pipe segment, to talk about the outlook and the performance of the steel pipes.
Thank you, Alexandre. Thank you, Costa. Also, I'd like also to welcome all in this 2025 review of a truly outstanding year for Cenergy, for cables, and as you can see, also for our steel pipe segment. It has indeed been a year of records, as it was last year, but even more than that, we have reached right now, as Mr. Benos mentioned already, record numbers in terms of EBITDA at 108 million euros, record numbers in turnover, almost 600 million, record number in terms of margin of 18.1%, in terms of EBITDA, and at the same time, as mentioned already, with a very reasonable working capital percentage of around 5 to 6%, and leverage of debt to EBITDA of 0.3, return on capital employed over 30%. These are outstanding numbers for a sector, as we mentioned, that it is considered to be mature and not at a growth phase. And maturity means both in terms of demand and also, of course, in terms of competition that we closely monitor. So there are competitors from our side that are far away right now from our numbers and our performance, and face strong hurdles and strong headwinds in terms of their backlog, while at the same time we grow and we capitalize more and more in what we do. This is a Corinth Pipeworks model that obviously works, and we are very proud about that. At the same time, from the demand side, we can say that generally there is a sustained demand when it comes to natural gas across the globe. We always look at the large diameter pipes in demand on a global scale and on a global basis. We can see a lot of demand in Asia Pacific right now. North America is super strong. The offshore and deep offshore market are always remain quite strong. Europe is weak from the traditional markets, but heading towards stronger terms when it comes to carbon capture and storage mainly. And hydrogen, even though lagging a little bit. Let's not forget, of course, that for us, what is important is that the infrastructure is being built right now, both for carbon capture and for hydrogen. The molecule of hydrogen will come at a certain point to get into the grid, but the infrastructure needs to be done right here, right now, and the backbone is being built with us having a very strong participation on all this. So all in all, we are cautiously optimistic for the next 2 to 3 years when it comes to the momentum of the sector, and we are truly optimistic on what we do. From the Greek side, from the Greek facility, also, as you can see from the more analytical figures, our CapEx gets smaller year-on-year basis. We have done already our investments in debottlenecking, in incremental capacity increases and cost efficiency. Let's not forget that one of the key points of our success is not only the increased sales in terms of value, but of course the cost efficiency and the cost effectiveness. This is the model that we keep being very focused on and having a very strong control in our cost structure, and this is going truly well. Last but not least, probably you have seen our latest news, today's news of an acquisition of a new facility. Hartlepool LSAW line in the UK is part of our plants now of Corinth Pipeworks, strong force. This is an LSAW plant with a very strong heritage from the past, very similar business model in the past with the LSAW part of Corinth Pipeworks. Nevertheless, this plant has suffered a lot of changes of ownership without any one of them being fully focused on the pipe sector. So right now, this was an asset deal, not a company deal, and these assets are going to be fully utilized by Corinth Pipeworks, and we are really proud for that. This doubles our LSO capacity and brings us with a new non-EU production footprint that is definitely important for various places geographically, and of course very important even for the UK decarbonization sector, which is strong and very and powerful right now, with various carbon capture projects and hydrogen projects being built and also designed for the future. So all in all, we remain optimistic. We are keeping costs under control, margins under control, and we look at the future with quite a lot of optimism, at least for the next 2-3 years that we can foresee right now. Thank you, Alexander.
Thank you, Ilya. So I will go back now to our boring numbers, and the story continues. Given all the above, the performance of this year and the outlook ahead, we estimate operational profitability for next year between 370 to 400 million, reaching our medium-term ambitions a year earlier. I will close with a note on our financial calendar, since it is slightly altered than last year. By the end of March, our annual report will be published. End of May, we do have our ordinary general meeting of 26 and the trading update on the first quarter results. And this year, it comes earlier, just before your summer vacation. We will announce in the first week of August the financial results for the first semester of 2026. I would like to thank you so much for your attention, and I now turn to our operator to give you a brief guidance on how questions and answers will work.